Well, hello everyone, and welcome to the Smooth Move podcast brought to you by yourdependablepartner.com. And we have a great guest with us. Joelle and I had the opportunity to sit and meet with our guest a couple weeks ago, and wow, you're all in for a real treat. Um, don't be confused by the Golden Gate Bridge behind her. Welcome, Tony. She's actually in South Florida. But Tony, do you cover the whole country?
No, I don't. I am in four states right now. I'm in Florida, Georgia, South Carolina, and Virginia.
Okay,
I know
down
that's an
south.
odd cluster. Georgia and South Carolina probably makes sense, but Virginia, you're like, why is she there?
Well,
So
Virginia
it's,
makes sense too. It's all part of the South. So
yeah, it is.
you
It
cover
is.
below the Mason-Dixon line. So that's a good thing. So we're going to talk today about a subject, that's very near and dear to me and should be really very near and dear to all of you because Tony is a national expert on a program called reverse mortgages. They're called HECMs, right, Tony?
Yep,
HECM
that's
loans,
right.
reverse mortgages. And I'm going to just say that this is probably the most misunderstood, most misused, most maybe even abused, and you can tell us how you feel about that program out there. But if you're a senior and whether you're doing extremely well financially or maybe not so much financially, I mean, we've had everything go up: home prices, food, eggs, clothes, gas, cars, you name it. Life has gone up in price. And this is a way um, to really deal with it. And Tony, I'll let you go into, I'm giving the hors d'oeuvres because I think this is so important for everyone to understand. Um, this program gives you options as a senior that you may not know about.
Mhm.
And I'm going to just jump in. Tony, you've been in the industry for how long?
35 years.
35 years. So you've
Yeah.
seen 12%, you've seen 9%, you've seen
I
1%,
saw 18.
you saw
I saw
18. I
18%.
see, I
Yeah.
started, and for full transparency here, folks, I'm a real estate agent as well as Joelle is, and I've been in the mortgage industry for 40 years. I'm sure my receding hairline shows that. Um, and so I'm very familiar with Heckam, and that's why I'm so anxious to bring this information because, again, as I said, it gives you options. So tell us a little bit about you first, Tony, and then we'll jump
Okay.
into the program and
So
talk.
yeah, I've been in Florida since 1989, but I am a Midwest girl at heart. I grew up in a very, very small town in southern Michigan. I came to Florida at 19 years old, and I stumbled my way into the mortgage business and have been doing this ever since. So it's been an interesting ride. I'm married. I've got between my husband and I, we have five kids. I have two of my own, and then he has three children. So we are entering the phase of empty nesting and trying to adapt to that whole. Everybody says it's this great space, but it's been a very mixed experience for me. It's
It's
I'm
like
not it's not coming as easy,
it's
no.
it's not great in the beginning. It's very hard, especially I think on moms. Go ahead.
Yes, it is. I thought it was going to be this easy, this amazing time period, and I've really it's been nail biting to say the least. So it's hard, it's scary, but yeah. And then so I've worked in every capacity in this business. I've from started at the front desk of an office and have run wholesale companies. At one time, had underwriting authority as a loan officer out on the street, and now I've been running my own broker shop since 2018. So I've seen the ups, the downs, the highs, and the very lows, and it's an interesting industry to say the least. And this space is super important to me. I had grandparents that I wish had understood the availability of this program when they were in their remaining years, and they didn't. And so their life looked very different than it probably could have had they had the benefit of these types of products
And
at
this
their
is not a
hands.
new program. This has been around since
No.
when? The 60s, 70s?
Yeah, the late 60s. I believe 68, 60s, late 60s, early 70s is when this came about. It wasn't always what it is today, right? It's got some bad press to overcome with good reason. The good news is that we need to educate now because there's still a lot of misconception out there that people don't go down this road where it could really change their lives and make things much better for them, but they're fearful because they've got information that's outdated.
Yeah, or information from a dirtbag.
That's
Excuse my
true.
language.
Yep.
There's no nice way to say. I was going to say scumbag, but I don't want to say it on the podcast. I guess I
I
just
like it. I
just
completely
said it
agree. In the
anyway.
wrong hands, this is a bad product.
This is the most missold program, and folks, that's why Joelle and I are so happy to have Toni here, because Tony's one of the good guys.
Yes.
And you have to be very, very, very careful who you're dealing with. I know you women out there may be awed by Tom Selleck and some of the other spokespeople for this. Um, just beware. So,
Yeah.
so Tony, tell what is a reverse mortgage? It sounds backwards. And then we
Yeah.
say we're going backwards and we can go forwards. And what does that all mean? It's giving me a headache. Go ahead.
Yeah. Yeah. So it's funny, so believe it or not, for people listening, a traditional mortgage is actually considered a forward mortgage. So just to help people start to gather some distinction, right? So in a forward mortgage, we borrow the money and we start repaying it 1 month at a time, principal and interest, and over time it gets paid off. A reverse mortgage is done in reverse. And so what's happening is you're borrowing money up front, or maybe you're just establishing a line of credit on your property up front and you're accruing interest every month, but you are not required to make a principal and interest payment on the mortgage. So you are still required to maintain your taxes, your insurances, any homeowners association dues, and you are required to maintain the property condition. So, but you're getting out of having to make that monthly payment, which for a lot of people, if you still have an existing mortgage on your property, right out the gate, you're eliminating that expenditure of that principal and interest payment going forward. So you can start to see pretty quickly how it can change somebody's household cash flow by eliminating liability.
So are
So
you
the biggest
saying
thing you
the
want to
house is
know is
going to pay you? Or is that what you're
yeah,
saying?
pretty
The
much the
house is
house is
going
going
to
to pay
pay
you.
you. Wow,
Yeah.
what a great concept.
Yeah. Yep.
So
And the flexibility is incredible in these programs.
what do you mean by the flexibility? Like you can take a portion of what your home is worth versus the whole amount? What other?
Yeah.
Okay.
Yeah. Yeah. So
Let's say you owe 300,000 on your home and it's worth 550. You can take all of that. How does that?
yeah. So
Let's do
not
something a
exactly.
little more concrete for people to understand.
Okay, so not exactly. So this is where it gets a little tricky, right? Because the dollar amounts that you can borrow are based on a couple of different factors. One of them being your age. The older you are, the more you can actually borrow against the property's value. Now, the second component that plays in is the interest rates. And it's the interest rate at the time that you secure your mortgage. And the reason that that plays in is because you are accruing interest on the mortgage while you have this outstanding liability. And the higher the interest rate is, the faster you would eat up the equity that's there. So the lower the interest rate is, and the older you are, would give you the maximum buying power. The higher the interest rate is and the younger you are, the lower the buying power would be. So it's not going to be a one size fits all answer. This is a very customized product and program for people. And it's super, super important that I think that one of the things that we focus on is we want to involve the financial planner, the family members that are involved in the person's life, the CPAs, as well as even the healthcare workers sometimes, because understanding somebody's long plans and expectations, realistic expectations about their ability to stay in the property are all very important components of that. So it's not an easy, I can take out 30% of the value of my home based on my age. It really is a formula that is going to be unique. And if there are multiple people, and they would be spouses, multiple people, and it's always going to be calculated off the youngest person in the property. So the younger you are, the lower that loan to value is going to be.
Question about that. So when you say the younger person, does that mean people on the mortgage or people living there?
So it's going to be based on the people. Basically, if you have a spouse, right, they're not going to allow you to take out a mortgage and not take into consideration a younger spouse. And, because what happens is when the time comes and you can no longer live in the property or you pass away, then the mortgage needs to be remedied. So if you have a spouse that's younger than you, that could be negligible because you could leave somebody that's in the dark. And that's the way the rules were previously. They would actually allow the oldest person to take out the mortgage. And now they don't allow that. Now they say, if you're married, we have to take into consideration the youngest person because we have to make sure that this mortgage is going to sustain for both of your life expectancies in this property. So we had a client that we're working with right now. We're in the beginning phases of it. She's in her early 60s. He's in his 50s. He's 57. We can still do that transaction for them. They have enough equity in their property, but it's done based on the 57-year-old, the math, not based on the 63-year-old.
So the
So
reason why I
how,
was, I'm sorry, Brian, go ahead.
it's an interesting question. So how old do you have to be to get a reverse mortgage?
Yeah. So to get into the government-backed program, 62 is your magic number. There are some proprietary programs out there that will go lower than that, but you've got to be very careful. You want to make sure that whatever path you take, you're in a non-recourse path. And what that non-recourse means is that if I end up passing away, leaving the property, and I have lived so long in this home with this reverse mortgage that I actually owe more than the house is worth, that they are not going to come after my estate or my heirs for that difference. All of the government-backed loans have that mechanism in place, so you're protected. And here's the good news too. I just talked to a family who they've had their mother in a reverse mortgage for 15 years. She is now getting ready to do a downsize into a property that's easier for her to maintain. And she actually still has $150,000 of equity in that property. So they will sell the home and that equity is theirs to move her into her next season of life. So it's,
See,
one of the misconceptions is
that's
people lose the house.
exactly. That's a big, big misconception. It's why the
Yeah.
children often say, I don't want you to do a reverse because the bank gets the house. Well,
Yes.
no, that's not true. And I'm so thankful you brought that up, Tony, because that really is a huge, huge misconception. But folks, we're in Florida. Home prices are going which way?
They go up.
What? Well, they're not going up
Yeah.
right now.
Not right now.
Yeah. Well, they're going down right now. Yeah,
They're
exactly. This
going down
season.
right now. And so I want to just say, if hopefully the trend won't continue, but let's say it does continue and you got a $400,000 mortgage and you pass away and your home is now worth 350, you know what you do? You take the keys and you give it back to the government and you say,
Yeah.
thanks, lots of luck. Have a good day.
Yeah.
And
Yeah.
if the house of 400 is now worth 500, well, you pay off the 400 and you get $100,000. The estate gets the money. So what a big, big misconception.
Yeah.
What are some other big misconceptions, Tony?
Well, here's another variable. Let's just say that you have a home that's a family home. It's a home that there's a long history, and the family's goal is to keep this home in the family, that they don't want to ever lose that. Well, there's also a mechanism that lets them buy the property for 95% of the value, regardless what is owed on the property. So even if you have that situation where you have a family member who's been living in this house that you want to keep from a legacy planning standpoint, you can be still safely allowing them to secure the reverse mortgage, knowing that even if they became upside down on it, which, historically, the only time that we've even seen that happen is during the financial crisis from 2000 and, I'm going to call it 2006 to 2012. Otherwise, it doesn't happen. They're very conservative in the calculation in terms of the amount that somebody can borrow based on their age and the life expectancies and the interest rates. And they're built so that ideally, as you age, your balance is going up, but there's always a gap on that equity to that balance. So, unless and I always tell a client, look, if you outlive the equity, you win. Because that means you took money out of this property and you lived such an incredibly long life, which would be amazing, then it's served its purpose. And it's interesting, that family that I talked to a couple weeks ago who is moving mom and they still have this 250 to 400 plus value on the house. They were thrilled to death. And I asked them, I'm like, I want to know what your opinion is today of the reverse mortgage. And they were like, we would do it again. It was absolutely the best thing we could have possibly done. And financially, it's been a really, really solid move for the family.
So tell me, what are the ways you can take the money? Can I get a lump sum and just go to Vegas and bet red and hope for the best? Or do I get a monthly check like Social Security, or do I get an equity line? I take it when I want it. How's it work?
all of the above are potential options now, with exception to taking to Vegas and putting it all on black. So these programs are not intended for people to make risky investments with any money that they take out of the house. This is about quality of life and protection and preservation of capital. So, depending on the client situation, if somebody comes in and all the equity position only affords them the ability to eliminate the principal and interest, then they would just basically take whatever outstanding balance, they would advance that on this, and then they wouldn't have the ability to draw any monies again future wise, but they wouldn't have to make that principal and interest payment going forward. The other alternative, the bigger the gaps are, is that they can establish a line of credit. And in some cases, our advice would be do not take an equity extraction, because if they have the loan there and they have the ability to get their hands on the money, but it's not sitting in a bank account, then it can actually impact their ability for qualifying for other resources, depending on, Medicaid, VA benefits, things like that. So it's very important that, again, we work with their CPAs and the legal counsel to make sure that we're positioning and understanding all of those different aspects of their life. But you can set it up if, let's just say, you owe nothing on your house and you want to go get a reverse mortgage, and you don't need to take an advance today. There's no immediate expenditures that you need to take care of. You can open the line of credit and it sits there until you need it. And then you can draw on it similar to a credit card, but you're not required to make those payments to pay back down. The other piece that you can do is you can set it up to where it would give you a set monthly income on a monthly basis to basically supplement your revenue stream. So that's another alternative. More times than not, I will tell you, we see people where we actually just say, hey, here's the line of credit, here's our recommendation. And then they just have to make sure that they're good bankers, because if they do get crazy and decide that they're going to use this money carelessly or when they don't need it, then it can be problematic, right? We don't want them to deplete that. Here's another piece that nobody ever talks about. If I set up the line of credit, and something that we'll see very often is that will be kind of a trigger for the need of this. If I own my home free and clear, somebody will have some type of a big investment that they have to make. Maybe the house needs a roof. Maybe they've got some immediate medical needs that they need to take care of, or renovations to the house that will enable them to continue to age in place. So they take that initial outlay on the money, right? And then if they just let that line of credit sit there, they didn't take out the total amount available, they'd let that gap remain. As time goes on, their actual available limit also increases. So when the line of credit is established, there is also a formula of appreciation that's calculated at 4%. They're making the assumption that historically your home is going to average a 4% appreciation. So if you haven't taken the full amount available out of the house, then your available money is actually going to increase. So when we have somebody who doesn't have the need, that really it is in their best interest to just let the line be there for their use when they do need it, it will actually grow. And so that's another piece that people understanding, being a good banker, if you will, and not being careless with that is super important, so that they can actually grow their access to funds as time marches on.
It's so critical because I see seniors that are struggling,
Mm.
really struggling financially. If the stock market's going sideways, if the Fed drops the interest rate and they had banked on a certain interest rate, income wise, when you're on a fixed income and inflation's running the way inflation is running right now, it's ugly. It's no nice way to say
Yeah.
it, right?
Right.
And this is the gap for many that not only allows you to age in place if you need medical assistance, of course, right? Nursing, whatever, but just to have some quality of life. My grandfather used to say, he died, he was 90 something. He used to say the golden years are rusty.
My father
So,
says, he's like, I don't know what they were selling us with this whole golden
right.
years thing,
Yeah,
but it was
they're
a
not so
bad, it was a
golden.
bad deal.
Right. They're a
Yeah.
little tarnished sometimes, the golden years, and this maybe gets the shine back. But I want to switch gears a little bit because one of the maybe biggest, things that is hidden from people is that you can actually buy a house with a HECM loan. So,
Uh,
so let me say it to you the way I would say it. You can buy a house, not make a payment, and and still be okay. Nobody's coming to foreclose. So go ahead, Tony. Tell us about it.
Yeah, yeah, actually, it's funny because most people don't, and people have trouble wrapping their brain around this one, right? You can buy a house. So how that looks is, and we see this happen a lot. People come into Florida and they get here and they're like, "Ooh, we didn't realize it was going to be quite this expensive to live here." We've
I see.
got, you know, $400,000, but the house in the neighborhood that we're going to be happy in to finish out our life is 600,000. Well, instead of them, you know, leaving, or, and a lot of times they're moving to be with family, right? But instead of them having to change their geography, they can use the reverse mortgage to buy the house and still live out their years in the house, in the life, in the community that they want to be in. So now they finance a $200,000 reverse mortgage and they don't have to make a principal and interest payment. So now they've gotten into the house as a purchase. So it's just the difference of, and more times than not, that person comes in really with the idea that we're going to make a cash purchase. And then they find out they don't have quite enough cash. Or the other thing that we're seeing a lot of right now, the HOAs and the condos have been hit significantly since the Sunny Isles catastrophe, and all the renovations that they have to do to get them up to code, and the assessments that people are getting hit with. A senior citizen on a fixed income is not prepared to have to throw out 75, 50, $100,000 in special assessments and then be strapped with an HOA bill that, you know, I've seen $1,200 up to $2,500 a month. That's a really significant impact. So what we've seen in that situation is, and the recommendation has often been, we have to get you out of this community and get you into a property that is going to be less expensive. So meaning, and not so much price point often as much as the recurring expenses of the HOA fees. So getting them into a community that's not going to need any kind of major capital improvements, and it's going to preserve their income stream because they're not paying out $1,200, $1,500, $2,000 a month in homeowners association fees. So we're seeing the move of, I'm going to liquidate. I have a significant amount of equity, or maybe I own my property free and clear. I'm going to use that money and I'm going to go ahead and go into my next home. And one of two things, it lets them buy in the price range that they want to be in with the reverse. Or the second thing is, and this has probably been more common that we've been seeing, is it actually is helping them retain a little bit of capital that they've had to outlay for those assessments and get that money back into their accounts to lean on. Again, it's not a unilateral direction that I would ever give somebody. I need to know what their total picture is. I have to talk to their financial planner. I have to understand what their health needs are. I have to understand, you know, whether they're going to continue to age in place for the foreseeable future, or whether there's something, if somebody's going to, it's imminent that in a year or 2 years that they're going to move out of their property and have to move into some type of a facility. More times than not, I will recommend they don't do the reverse mortgage, that they probably need to maybe plan to make the move a little bit sooner, but that the reverse mortgage is not something unless they really foresee being in that property for the foreseeable future. Makes sense?
It makes total sense.
Yeah.
And I'm speechless because so few people are that honest. You hear what you just heard, folks? You heard a commissioned salesperson tell you sometimes it's not right to get a reverse
Yeah.
mortgage. I just want to emphasize that. And that's why we were so fortunate to bring Toni on. And I kept saying she's one of the good ones.
Yep.
There's so few. Tell us real fast, and we're going to wrap up soon, Toni, but I think you've given a lot of really great nuggets. Tell us a couple mistakes to avoid. Probably the one that's
Yeah.
calling you at 8 o'clock at night from the boiler room in their basement, trying to, you know, get you to do
Yeah.
something they shouldn't be doing.
I think that if you ever are on the phone with somebody and they're trying to force this decision, this is not something that should be made in a snap moment. This is something that needs to be thought out. And if they're not asking you a lot of questions and bringing other people into the collaboration, then I think that's a red flag. If you know, many people, not always, but many people have adult children that are involved in helping them navigate their, you know, aging, and those children should be part of that. And especially the financial planners, especially the CPAs. And then one of the questions that I don't think many people ask hardly ever, if ever, is, are you currently getting any in-home health services provided? Because again, understanding, you know, it's possible if you have a debilitating condition that is going to require you to go to a facility, you have to know that. If I don't ask that question, I won't know that unless you volunteer it. And you may not think that there's any relevancy to that in a financial transaction. So I think that the biggest red flag is when you're on the phone, and this applies to everything we do in life, right? Even any type of real estate transaction. If somebody is not asking you a lot of questions, how can they possibly be consulting and giving you information that is going to enable you to make the best decision? You can't put a puzzle together without missing pieces. So you have to really plug in those pieces. I think that that's probably one of the biggest red flags I would say is you've got to make sure that somebody is really deep diving your whole picture, and don't be shy. It's not because we're being probing or we're trying to get into spaces that are not important. It's because we're trying to make sure we're protecting you. And if that
And
person's not asking those questions, then they don't care. They're looking for a buck, and they're not concerned about whether or not it's the right solution for you. I had a client in the condo situation. The guy he was down to his last $75,000 in liquid cash. He was already, his HOA fees had already gone up to $1,200 a month. His social security income did not support anything more than just his HOA. It didn't even cover his taxes and insurances on the property. His kids came to me. We talked about it. The client was talking to somebody else about a reverse mortgage. And as you mentioned earlier, the dirtbag closed him on the reverse mortgage. He was attached to the lifestyle that he had in the condo. But the truth is, it doesn't matter how attached to it is, his money is not going to sustain him to live there. And so to me, what that person did was criminal, and it's not the right thing. And that's where, and look, there are times you do have clients. I understand that sometimes a client can be so strong-willed that they have, they see something or think something, but that's where you've got to have these other people that are in professions that can help people see the numbers and line up and show them, look, your money's not going to last. You're not going to make it. And if you get one more special assessment, you're toast. Now you're going to have to fire sale the property. How much is that going to cost you?
Mhm.
And so it's just really, really important that you're deep diving the consultation piece of this. And if somebody's saying throw flags on something, there's a reason for that. Ask questions. Just don't be afraid to ask
Do
questions.
they have to have good credit to do this? Is credit
No,
report even pulled?
the credit is pulled, but you could actually have somebody that's in distress. You could be in a foreclosure situation. And if you have a significant amount of equity, a reverse mortgage could potentially be a
Entry
vehicle
level.
for you.
Yeah.
What they will do, they call this a LISA. It's a life expectancy set aside. So what that is entailing is your taxes and insurances. So when you do a traditional reverse mortgage, as I mentioned at the beginning, is you're responsible for paying your taxes, your insurances, your HOA, and maintenance of the property. If you're in distress now, they will force the LISA, the life expectancy set aside for the taxes and insurances. So basically what the servicer is going to do is build that reserve account so that every year the taxes and the insurances can get paid on your behalf, and it's not something that you're going to have to manage. And they'll do that because of the distress that you're currently facing. But yeah, it's very forgiving. And even from an income calculation standpoint, this is not a traditional income qualifying product. They are more concerned about your disposable income, and that calculation is done based on a couple of different variables, one being the actual size of the property. They actually have a calculation for what they anticipate utilities are going to cost. The goal is never to put a band-aid on a situation that's going to ultimately end up in a foreclosure situation. The goal is to legitimately solve somebody's problem so that they can live comfortably for the rest of their life.
And there's counseling they have to take, correct?
Yes. Yes, I love that piece of it. It's not anything that any of us, I can't even legally help somebody arrange that. We give them the links to the government agencies that are allowed to do that. And I love that those people have nothing to do with the transaction. So yes, they will charge you a fee, but in terms of whether you take it or you don't take it, they don't care. There's nothing for them to gain whether you decide that this is the right vehicle or not for you. And I love that. I think I urge my clients to bring in any family members that they need. And if they don't have family members, that if they have a financial person that's alongside of them, that they bring that person in and let that person participate in the counseling as well. So that, because we all hear different things based on our perspective in our life. So having multiple people there to make sure all the questions are answered and understood, I think is a really valuable piece of the transaction.
So, Toni, how do they reach you?
So our office is 561-373-0371. And obviously our website is www.interconnectmortgage.com. And then email is teamtaylor@interconnectmortgage.com.
One more time.
Phone number is 561-373-0371. Website is www.interconnectmortgage.com. And email is teamtaylor@interconnectmortgage.com.
So, folks, if you want an honest answer, an honest assessment, and just for just for argument's sake, you also do forward mortgages, right?
That is true. Yes, I do.
VA conventional. So if you need a standard loan, you should
Yeah.
call Toni as well.
Yeah.
So I want to make sure we give you a holistic here that you do everything.
Well, thank you.
But your expertise is certainly in reverse mortgages. So I can't thank you enough, Toni. And I hope all of our viewers and listeners really got a bunch of good nuggets, because it really is a missold, misunderstood, wonderful program for the right person or people in the right circumstance. And it takes a Toni to make sure that that really is looked at properly and sorted out properly, and the recommendations are personalized for that. I always tell people, it's funny, in the mortgage space, they say, "Oh, my friend told me this, and my friend told me that, and my friend told me to do that." And I used to say, "Well, is your friend a mortgage banker?" Because, like, I wouldn't want to go to a dentist, whose specialty was toes. Um, if you talk to the expert. And how much does it cost to talk to you, Toni, by the way?
Nothing.
Right. So
Not a thing.
it's a great price, folks.
Yeah, it's a
Can't beat
great
the price.
price.
You can't beat the price, and don't abuse it, but certainly you need to get feedback from professionals. And in Toni's case, it's not only going to be Toni, it's going to be a collaboration of all the professionals that serve.
Yeah.
So anyway, I thank you. I thank you for being a guest. I thank you, our viewers and subscribers. If you like this, leave your comments below, hit the subscribe button. Every week we come to you with more information to help. And of course, we want you to go to yourdependablepartner.com. We are a senior move management company, flat fee, very transparent, and we make sure you're packed, unpacked, and sleeping in your bed that night in your new community. If something needs to be auctioned, we'll make sure we get that taken care of. If your home needs to be cleaned out, we can take that. We can take care of that. If you need something shipped to relatives across the country, we can handle that. And if you're in a property and you need it sold, we can help you with that as well. So that's it for this week. We'll be back again next week. I thank you, and hit that subscribe button and give Toni a call.